Hi, everyone. This is Jason Bierk of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. He is founder and CEO of artificial investing firm Complete Intelligence. He also used to work at The Economist and IHS Markit. Tony Nash, thank you for joining me again.
Thanks, Jason. Thanks for having me.
So, Tony, we're recording this interview on Thursday, June 15th, 2023. We've had a crazy rally the last couple of weeks. So initially it was four or five large cap tech stocks. Nvidia was the main headline, but also Microsoft, Apple, and a few, I think Meta, Amazon, a few others. But recently in the last week or so, we've had a rally in regionals. The small caps, the regional banks have had a big rally. Maybe it was just a suckers rally or short squeeze. And then this week we've had a rally in a lot of the S&P 500 companies. So do you think we have a new bull market here?
Well, yeah, it is technically a bull. It's up 20% as of earlier this week. So yeah, we're definitely in a new bull market. I think the Fed's pause this week gave people more courage to see equities as a priority for the Fed. And so I think people are thinking that the Fed doesn't necessarily want to kill the equities bubble immediately, which if they would have come in with 25 and done another 25 in July and so on, it would have been a clear sign that that's what they wanted. But I think the communication from Powell this week was not necessarily as hawkish as, what I expected was either a dovish rise or a hawkish pause. And he did a pause that wasn't exactly hawkish. And so I think that was a signal to markets that the Fed is happy to entertain markets rallying for a while.
But this doesn't look like the classic conventional bull market, though, does it? Because before we started recording, we were just talking about some of the distortions and trying to look back through financial history and see if there was anything similar to this. You mentioned that there's rising rates at a record rapid pace, but also rising valuations. I was trying to think if that had happened before in U.S. financial history. The only thing I could think of was the 70s stagflation in the early onset there when Arthur Burns, the old Fed chairman before Paul Volcker, was raising interest rates.
Yeah, I mean, it's also interesting to look at the 20s where, we had war and Spanish flu. Then we had a recession and a terrible bear market in 21. And then we had things continue to rise through the 20s. But that was really uneasy monetary policy. It wasn't as rates were rising. So, I think what you're talking about with Arthur Burns in the 70s, I think that makes sense and that can last some time. But the market wasn't as, I guess, financialized. It wasn't as broad. There wasn't as much information and so on and so forth. So, that bull market that lasted a few years, will it continue to last a few years now? Maybe it will. But I'm just not sure that it will continue as long as it did back then.
And for listeners who are not familiar, the stock market, the U.S. stocks actually rose for a while as Arthur Burns was raising interest rates. So the stock market was outpacing the official inflation rate, but eventually Paul Volcker came in and kept raising rates, and then that broke the stock market. But I would say that there's more of a divorce now, Tony, between reality and asset price valuations these days, because a lot of the data that a lot of these companies are reporting, I wouldn't say is bullish, but the stock market seems to be shrugging a lot of it off.
Yeah, I think a lot of what people are looking at are jobs. It's indisputable jobs remain strong. Okay, so I think that is the one metric that everyone from the Fed to to individual investors go to say, hey, look, we've got strong jobs, strong job growth, we've got strong wage growth, and so on and so forth, and that really is helping, say, the housing market. It's helping the equity market. It's helping retail sales and other things. We just had retail sales reported; it was stronger than expected. These sorts of things. So I think there's a belief that spending will continue on the back of a strong jobs market, and I don't necessarily think that's a flawed belief. I think the problem with that hypothesis could come with a resurgence in inflation. So here we are in June, and in 22 we had crude surge in June, July, and then fall dramatically after that, right? So the base effects will likely make inflation, and we've been saying this for, I don't know, 9 months or 6 months or something. Base effects will likely make inflation look like it's not very high in June, July. And the danger is for people to declare victory because you had the primary, secondary, tertiary impacts of crude at $130 last year. And you just don't have that this year. You have weak crude prices, and the secondary, tertiary impacts of that are show disinflation in some ways, right? So my expectation is that over the next, say, month or 2 months, people are going to start declaring victory over inflation when in fact we could have some secondary, say, waves of inflation coming in, say, August, September, October.
And oil is getting dangerously close to production costs. I mean, I just found the research on the chart from Statistica that was pulling all the data from a lot of the oil companies here in the United States for oil and natural gas production. They were showing that new well drilling costs for a lot of the non-Permian Basin is $60 or more. So we're getting dangerously close to production cost levels, and the rig count starting to fall. So I don't know how much lower oil is going to go. I know a lot of global macro hedge fund guys are shorting energy and oil, and they think it's going to go lower because the amount of net short increases has just been piling on a lot for months. But at some point with the rig count falling, I think we're going to see a lot of supply come offline.
Yeah, well, you have OPEC with a slight cut. You have Russians saying they're going to comply with the rules there, which I'm not sure if they will or not. And you have rig counts falling. So, we could enter a zone in Q3 or so where we have some supply shortfall. So, but between now and then, yeah, it's quite possible. Outside of nat gas, which we saw surge almost 9% today, it really looks like we're in kind of a low energy position for the next maybe couple months, which is seasonally awkward.
Yeah, for our listeners out there, normally in summer driving season, here in the United States, that means that gasoline prices are going to go up, oil demand is going to increase, right. But the oil price has been weak lately.
Right, that's exactly right. Yep. So we should see that stuff surging, but we see those prices coming down, and we see this market consensus that those prices should be lower. So, how long will it last? Probably through the summer, and once we see that production capacity cut back, we may see OPEC, cut back even more, which would put upward pressure on prices, but that's not going to happen right now.
Another thing that I think people missed is that the global money supply. So it's a lot of people are way US focused. They only see what the Fed is doing. They don't see what the Fed is doing relative to other central banks. So the Fed has been more aggressive at hiking interest rates. That's why on a relative basis, the dollar is stronger, but other currencies are weaker. And global money supply, Tony, I saw a really interesting chart about this. It's actually close to the 2022 highs. So yeah, the US is draining liquidity. Yeah, the Federal Reserve Bank is reducing its official balance sheet, but that's not the case for all these other global central banks. And I think a lot of the liquidity has been ending up here in U.S. stocks. So kind of a mini dollar milkshake, or kind of an aftershock.
Yeah, that's without a doubt, I think. And as we were saying before the call, China is having to really adjust their money supply, actually, and their monetary policy in the wake of just a really difficult reopening. And they're going to have to get much more aggressive on stimulating their economy. So we'll likely see CNY depreciate even more. And as we see more supply of CNY, we'll likely see some of that convert to dollars and end up here again. So, all roads lead here for now, especially as we have the Fed continuing to tighten.
And for our listeners out there, the Chinese yuan has already been depreciating against the US dollar. I think it's down to 7.3 Chinese yuan to the dollar. But China hedge fund manager Brian McCarthy told me recently he thinks it's going to around 7.5 Chinese yuan to the dollar probably by the end of the year, if not sooner than that.
Yeah, that seems sensible. Yeah.
So I want to get your thoughts on NVIDIA. They seem to be the leader in artificial intelligence, but a lot of people are just buying NVIDIA because of the chart. So what are they trying to do in artificial intelligence exactly?
Well, so NVIDIA makes GPUs, which are used to process very sophisticated artificial intelligence routines. And it also processes a lot of data along with those programs. So there are not a lot of competitors who can do the things that NVIDIA's chips do. So, you have AI companies like Palantir, which is really a consulting company. You have companies like C3 IoT or C3, again, really a consulting company, and NVIDIA, because people don't really know where to invest to get kind of the AI buzz. They hear this a lot, and they hear Meta say that they're, doing AI, and they hear Google say they're doing AI, that sort of thing. But people are trying to find AI pure plays, and it's really hard for them. So I think NVIDIA is probably one of the closest derivatives of pure play AI that you could get because of their GPU business. Again, C3 and Palantir, largely consulting firms, they've rallied a lot this year. But again, they're consulting firms. So NVIDIA and chip makers that are really pure play AI type of chip makers, which there aren't many, are getting a lot of attention. And that's really what NVIDIA is about. I don't know many, say, retail investors who actually understand the AI environment, but over the past few months, they haven't had to. They've just seen NVIDIA rally and they've made money.
For our listeners out there, Tony actually runs an artificial intelligence company that takes big data and analytics, and he makes his own algorithms, and he has very accurate forecasting with investment data. So are there any actually companies that have an artificial intelligence product, so a pure play, that are selling it, or it's kind of like it's going to be AI in the future? Because obviously you have OpenAI systems and ChatGPT, but that's not publicly traded.
Yeah, I mean, I do think that Microsoft is doing a very good job of capitalizing on the capabilities of ChatGPT. I haven't been all that impressed with Bing. When I said Bing side by side with ChatGPT, I think the execution there is a little bit flawed, which is probably typical of Microsoft with search. But I think they'll get better. So, is Microsoft pure play AI, ChatGPT? Of course not. But I don't think many companies that size will be. I think AI is something that continues to be, it continues to make existing products and existing capabilities better, higher quality, lower error, higher reproducibility, those sorts of things. And if you look at something like ChatGPT, so I ran research at the Economist for a while, and I would have to hire associates straight out of school and teach them how to write and teach them how to research and these sorts of things, right? So once I started playing around with ChatGPT, I realized that entry level analyst that I used to have who would write papers for me and do research for me, those sorts of tasks, I won't really need those people anymore, or as many of them anymore. And so, I think what we're seeing is less about a single company than it is about a kind of a movement among larger companies. Of course, smaller companies will try to enable it, smaller companies like ours. But I think what companies will realize is, for example, if anybody is using Excel for 40% of their day or more, they actually can be replaced. Okay. Generally, people who are calculating in Excel, doing things in Excel, initially those jobs will be augmented through AI, but over time, the manipulation and the output that those guys have, those will be replaced. And so we're in the same way we had this real productivity boom in the 1990s. I think we're entering an era of productivity. There's going to be a lot of resistance. There's going to be a lot of misapplication initially. If you think of the kind of early internet, like the pets.com type of application of the internet, it just didn't really fit. So we're going to have some misapplication of AI at the start, and people are going to think that it can do stuff that it really isn't appropriate for it. It's like, Jason, when you see people do a search of, political questions from a Democrat and a Republican point of view, and they try to compare them, it's like, it's not really meant for that sort of thing, right? It's really meant, when you can put a specific prompt, when you can engineer a specific prompt in something like ChatGPT, or when you can program the right algorithms, say for time series forecasting or something like that, that's the right application for this. At this point, there is no such thing as a artificial general intelligence, meaning an AI that can replace a human being fully. But I think what the market is experimenting with is, what is the right application of AI? And we had, 5 years ago or so, we had consulting firms come out and charge people millions of dollars to implement AI. And most of those failed, right? They just became analytics projects and they failed. What we're finding now, and I think ChatGPT has really opened people's eyes up to how interesting this can be and how AI can actually help to enable organizational productivity. So it's not just searching the web and, finding the best deal on a vacation. It's really, how can we use large language models to compose justification and text and reports and other things, right? For customers or whatever, right? How can we use, say, a large language model to develop a marketing plan? I just did that a couple months ago. I took 45 minutes with a large language model to develop a marketing plan for my company that would have taken probably a week and a half. Okay. So it's not that it's doing things that are all that new. It's just doing it in a more productive way.
And if our listeners want to check out the secret sauce behind how you do things at Complete Intelligence, you have an interesting diagram there. It looks like you need a bunch of other technologies in order to, before the artificial intelligence program and the prompt, like you said, because without big data, without other analytics software, other algorithms, this stuff is not possible. So you need all these technologies stacked on each other first.
Yeah, so just to dig into that a little bit, I didn't want a shameless plug at the start, but I'll tell you how we do what we do. We work with ERP systems, say corporate ERP systems, and we will forecast, say, supply chain costs. We will forecast revenue and expense budgets. These are things that within companies take hundreds of people to do on a regular basis. And what we're doing is, when we onboard customers, we compare our output to the output that's done internally in companies. And what companies find, when they hear about AI, they initially think, oh, I don't want to install a black box. But within large companies, you have Excel models with macros sitting on every analyst's desk. So there are actually hundreds or even thousands of black boxes around big companies. So what we do is we have a consistent way where there is a feedback loop to understand where there's error, so that we can then really augment the budget process, or we can augment the supply chain planning process. Those types of data-driven forecasting processes, we augment those processes and save thousands of hours for our customers every year. And so that's really how we're applying AI. Now, that requires a lot of transparency, performance transparency. So, when a company does a budget, do they really look back each month and say, how far off was the budget? Of course, they look at how far off their performance was, but nobody really wants to apply that social pressure internally to show that someone's budget is wrong, because it's really awkward. So what we allow people to do is blame the AI when a budget is wrong. And we have a continuous budgeting process within companies. So we're taking really boring things like budgets. First, we're augmenting the processes internally and the people internally, and ultimately we're automating those processes. So those are some of the kind of really boring things that we'll see when I talk about this kind of AI movement. It's those types of really boring activities that we're trying to automate across large companies, so that the people within those companies can do more interesting stuff.
It sounds like big productivity gains and big efficiency gains, similar to the supply chain software. I mean, I remember hearing stories about large companies that had enormous supply chains from decades ago, and the sales manager, the person at the top of the sales director office, they'd have to make a bunch of phone calls and emails back to all the sales managers and all the regions and figure out the supply chain. But nowadays, you have everything integrated on the software, and the person can pull up like an iPad, and everything's integrated in real time.
Oh, yeah.
You have RFID chips. You're going to have blockchain software, privatized blockchain software, or something RFID attached to that, and that just made the supply chain super efficient compared to the past.
Yeah, so it's interesting you tell that story. I graduated from undergrad in 1993, and in my first job, they put me in-house at Gap Banana Republic, their headquarters in San Francisco. And I was in their supply chain department. And the team at that point had 3x5 index cards for every PO that they ordered all around the world. So if somebody wanted to know what was going on with that merchandise, you had to go to these 3x5 index cards and look at handwritten notes as to where that shipment was. Was it at the factory? Was it at the port? All of this was a manual process that you saw on these paper index cards, and gradually that turned electronic, and then now you have really real-time visualization of where every component to that supply chain is. That was just that was 30 years ago, right? Which seems forever ago, but it also wasn't that long ago when you look at the technology advancements we've made because of things like GPS, because of things like ERP systems, because of supply chain systems. All of this stuff really allowing us to see where those things are in real time. And that allows us as a company, we take one of our customers who is, say, ordering medical supplies from Asia, and we help them understand exactly what will impact their prices with a 3 to 6 month lead time, so that they can know when to order products and when to just accept the price that the vendor is giving them. So all of that real-time information, what was 3 decades ago on index cards, now it culminates to allow people to bid on real-time prices based on other things they're seeing in the market.
Yeah, and decades ago, even as email was just becoming popular and internet connections were slow, I mean, the sales director would have to make a bunch of phone calls or emails, and it would take a week or more to get all the information. Now they can literally, I've been listening to conference calls, and the sales director pulls up either the laptop or the iPad on the conference call, and they get the information in real time. It's amazing how efficient things have gone.
Yeah, but it's amazing. But Jason, what's so fascinating to me is it's actually boring. Because
we take it for granted. We take it for granted.
This information is all at our fingertips. And so this has become really boring to us. And I love that. I love that we can have that information at our fingertips instantly right now. But, as you talk about it, I'm thinking, yeah, that's cool, but that's kind of what we expect.
I think we take it for granted, but then also, Tony, it creates new problems. Like, look at all the information here with the Fed raising interest rates. And then with the regional banks, all it takes now is a rumor about a small regional bank to have a problem or a higher interest rate at another, a money market account or treasuries. And all of a sudden there's a digital bank run in 24 hours.
Yep, that's right. And then all the private equity firms and VCs pull their money out, right? So, yep, it happens very quick.
So I want to actually get your thoughts on banks, because the banks, we've had a rally in regional banks. I think it's a sucker's rally. I think if the regional banks can sell equity capital, a few of them will, and then the rest of the shares will not be able to sell it. The rest of the companies won't be able to sell equity capital. Have you seen past instances in history where there's a bull market and the financial sector or banking sector is this weak?
I'm sure there have been. It doesn't come to mind right now, but Jason, as you mentioned regional banks, what has come to my attention over the past few months is, with commercial real estate, with the issues we're seeing in commercial real estate with low vacancies and the valuations of these properties being down, 30% or more, especially in places like San Francisco. The regional banks, while we just came through this Silicon Valley Bank, Silvergate issue, the regional banks are also very exposed to commercial real estate. And, you're right to point out that, where things are rallying, we have interest rates rising, but we have regional banks in very difficult spots. And as we see commercial real estate have to market, and those loans are revisited, regional banks are very exposed to that. And so, this rally that you see, if you look at, say, KRE, the S&P regional banking ETF, it's back off of the lows that we saw in mid-May, which is great, right? I mean, there's confidence in the sector, or growing confidence in the sector. It's not back up to, say, the 50s where it was, but there's growing confidence in the sector, which is great. But if we see more, say, tremors in commercial real estate, and that starts to hit the books of the regional banks, then the regional banks will become very, very stingy with their lending. And we risk a real credit crunch with small and medium businesses small and medium businesses are who these regional banks lend to. So we could see credit get even tighter for small and medium businesses, and that is really not good for jobs in the US.
Yeah, I agree. I see a lot of signs from a lot of these companies, especially consumer discretionary, that things are not quite as good as they appear. Yeah, I think inflation has actually, higher inflation rate has actually filled the gap for the last 12 months on consumer spending. So yeah, consumer spending, if you look at the data, it's still relatively high, but I think a lot of it's because people are paying more money to maintain their standard of living.
Oh yeah, and we had this from really second quarter of 22 until now. We've had this phenomena where companies would raise prices, and the classic one is Cracker Barrel, right? Where Cracker Barrel would raise prices by, say, 10, 12%. They would have higher revenues, higher margins, and their volumes wouldn't really suffer. And that happened. And because people had higher incomes, they could justify spending more, and it wouldn't really impact the number of times they could go to Cracker Barrel or to Walmart or to wherever. But because inflation is sticky and people are having to adjust to these higher prices, what we've seen with reports from Cracker Barrel and other people for the past quarter is they haven't been able to push price like they had before. So we've reached a new pricing level, but it's not those companies are not able to push it much higher. So they've hit their peak for now, or close to it. And it's really started to impact the volume in their stores. So we had a time where inflation didn't really hurt volume, but now inflation is hurting volume, and that's a real problem for everybody. So, the question from here on out is, how much more will volume hurt even at the current prices? But then if we see a second bout of inflation in September, October, after these summer base effects wear off, will say Cracker Barrel and other people have to raise their prices even more, and then will that hurt their volume even more? That's a real question that I'd love to know the answer to. But I think that we could start to see some pain in some of these. If we have a second bout of inflation in September, October, we could start to see some pain with some of these companies in Q4.
I think we're seeing a lot of distortions too, because I'm getting these email blasts out with some companies slashing prices, but it's the department stores, it's the men's clothing companies, it's the men's shoe companies, it's the Best Buys, the electronics, the high-end, the big ticket items that people are not buying. So that's where the price slashes are coming. I guess the consumer either is buying less or they're being a lot more selective, maybe because they don't want to take out super high interest credit.
Yeah, and I think people are tapped out. We hear this, and people laugh when we say this, but I think maybe they're not fully tapped out. But I think in general, I think people are weary of spending money at this level.
It depends on your income, I guess. So
yeah, absolutely.
If you
Absolutely.
have a 3% mortgage locked in, I think it's probably easier. Just hearing there's not demand for mortgages at the sky high interest rate. So a lot of people don't want to sell their house if they have a 3% mortgage on a long-term mortgage locked in.
Right. Yeah. And I think that, on some level, that also comes down to a cash flow basis. So if inflation continues to bite and people have to, say, buy a new car or send their kids to school or something like that, they're going to refinance to take cash out. So is that going to be everybody? No. We're going to have a lot of people with 3% mortgages for a long time, but we're going to see at the edges where people have to refinance. And that's how banks are going to get better terms with some of these borrowers.
But I think the real mess for this cycle is commercial real estate. I think we're just in the first inning, because we've seen the chief financial officer for Wells Fargo this week, the CEO for Goldman Sachs, they're warning about write-downs, but we haven't seen massive bank failures yet for the regional banks. We've just started seeing what the largest hotel in San Francisco handed back. So it's bad news every day, but no enormous kind of domino effect or contagion yet.
Right. And when we start to see REITs like the Blackstone REIT, start to allow customers to, they've really locked people in, right? So some of these REITs have really had tough terms with their investors. So once we start to see those guys have to mark, and we see their investors start to pull out to reallocate, I think we'll see things accelerate fairly quickly.
A few more questions before I let you go. So I know you cover a lot of these dividend stocks extensively. Is there any specific industry you think where there's cheaper valuations and safer dividend yields?
Oh, I wouldn't necessarily. Well, obviously not in new tech, but if you look at things like old tech, there are some really interesting companies there. I would be looking there. I'd be looking kind of old manufacturing, old retail, those sorts of things. Those are places that I would look. Even energy, with some of the energy companies, there's some really interesting dividends there. So I'm, but I think it's a really tough play right now, given that we're in a bull market. I don't think, especially with tech, I don't think many people are really looking at dividends. I think they're just looking at return, based on the rally. So
you think then that a lot of people are going to be moving money out of the almost 5% U.S. Treasury direct, out of money market funds, are going to be chasing those tech stocks higher?
Oh, I think they're already doing it. I think they've already done it, and I think they're doing it. But again, I think we're at a place. I can't remember if we discussed it here or before the call, but I think we're in a place where people are questioning how much upside is there to this market, 20% or 5%. And I think with that calculation, I think we'll start to see some people kind of say, I'm going to take some chips off the table and put them in some treasuries or something, because valuations really are so stretched that I think some individual investors are a little bit nervous.
I also think a lot of these companies, they're going to need to sell equity. I mean, we even saw that with NVIDIA, right? So NVIDIA started doing share dilution, but I think the shares have rallied anyways. So I think if NVIDIA keeps going up in the short term, I think that just increases the probability that it's going to crash, because too much short-term profit seekers, the short-term traders that are just looking at the chart are chasing it higher, and that's going to increase the probability of a crash later on.
Yeah, if I was NVIDIA, I'd be doing the same thing though, right? Because they're in a position they can. I mean, look, when I hear people talk about NVIDIA, I also, it makes me think about Apple on some level. I heard people for years say, Apple's way too rich. It's got to come down. And given where NVIDIA is, and given its relatively unique capability, I just don't know. It's possible we see a crash. And I know we have 40 years of future earnings, tied into the valuation right now, but I'm just not sure. The real Achilles heel that NVIDIA has is China, because they're so dependent on China for their supply chain that if anything happens geopolitically with China, there's a real problem with NVIDIA. And so if we had, let's say we had, Donald Trump come back into office in 2024 and the trade with China was locked down, that could be a real problem for NVIDIA. So NVIDIA needs to diversify their supply chain really quickly, put some fabs in Mexico or something, Arizona, whatever, because they're so exposed to China that I think that's a real risk that people are overlooking.
Does NVIDIA have their own ecosystem though? So I don't know if it's this, no pun intended, apple to apple comparison, because Apple has like a unique ecosystem where once you start buying iPhones and iPads and MacBook Pros, you really can't leave. It's a very, very difficult to move all your data and your pictures and your music over to Microsoft Windows or competitor.
Yeah. Well, the software development environment, these sorts of things, it's not closed. That's one thing that NVIDIA doesn't have that Apple had. It's not a perfect analogy, but over the past month or so, I keep hearing people say NVIDIA is going to crash. At the same time, it continues rising pretty rapidly. So I'm just not sure. I'm not saying it's not going to happen, but I'm not necessarily convinced because of their relatively unique capability, at least at this point. I think there will be a tail to this. I don't necessarily think that there's somebody coming to kind of take their market spot right now. So it may, these rich valuations may deteriorate over time, but I don't know, short of a major geopolitical supply chain event, I don't necessarily know that we're going to see NVIDIA, bounce way back down really quickly.
Well, what worries me about NVIDIA is a lot of the people that are buying it know nothing about AI or any of the fundamentals. It's solely short-term price seeking, people looking at the chart, people gambling and speculating.
Well, it's crypto, right? It's, somebody was talking to you about how their aunt was asking about NVIDIA today, and she knows nothing about tech. And so, this is, people are always looking for some sort of return because these wage gains have helped people, but it's still not helping most people keep up with inflation. So people are desperately looking to markets to help them eke out a few extra bucks so that they can keep up with inflation. That's the real dilemma that we face right now.
There's big risk there, though. So when you try to get rich quick, you're taking on extra risks. I mean, there was a ton of people that all they bought was, they didn't know anything about fundamentals on stocks. They were buying stock options on meme stocks. They were buying altcoins, NFTs, all these different cryptos. They considered themselves diversified by owning a few cryptos. And then we had a big bust in a lot of these altcoins.
Oh, yeah. No, but again, that underscores the seriousness of the Fed trying to tackle inflation, and I hope that the Fed doesn't stop raising rates. Not that I am hoping for a crash in markets, but I am hoping that the Fed doesn't see the, say, June, July results in inflation, declare victory, and then not tighten at all, because people are hurting because of inflation. A lot of people are hurting because of inflation, and it's very, very difficult. And that's, again, part of the reason people are chasing after NVIDIA and this very tight group of tech stocks where they believe they can get a quick return.
Yeah, I agree. People are getting hurt really bad with stagflation, shrinkflation, and taxes. And even if inflation stays at like 4 or 5%, I mean, that over a long period of time, it just adds up and it really hurts people's standard of living.
That's right. Absolutely.
The point I wanted to bring up with Apple, though, is the old Warren Buffett term about like a consumer monopoly or a moat. So Apple has that moat. People are paying their cash flows. So if you want your photos stored on the cloud and your music and all this, Apple's just collecting monthly cash flows from people. So NVIDIA might be the leader, in the chips, like you said, but they don't have that moat that Apple does, where basically like there's all these high fees and opportunity costs and problems to sunk costs, basically the economics term, to leave the Apple ecosystem. So Apple's just collecting all these cash flows now. Now, I don't know how much growth Apple has, but they certainly do have a moat for now.
Sure, yeah. And NVIDIA does have some ongoing revenues. It's not completely out of that. But again, as I said, it's not a perfect analogy. But I do think that they have an advantage as to where they are technologically. I'm not defending the valuation at all. But I am saying I'm not necessarily sure that they're going to kind of completely fall off a cliff because of how unique they are at this point.
But you think they do have a clear lead in technology, though, and intellectual property?
I do. And the recognition of their lead is is clear as well. So yeah, I think it's going to take a while for people to catch up and for them to be recognized. So if you invest in an alternative chipset, alternative GPU, it's an experiment until it's proven. And so NVIDIA is proven, NVIDIA is well regarded, and so it's a safe buy. Whereas other chipsets in the space, it's a little bit risky, and so it's going to take a while for other people to be recognized at broad scale.
I think Taiwan Semiconductor, aren't they opening a factory in Arizona now?
Oh yeah, yeah.
So I don't know how they are in intellectual property competing with NVIDIA, but I think like a lot of these chip companies were in China and Taiwan, and it looks like they're going to have to, like you said, move to Mexico or the US rapidly.
Oh, definitely, because of the political risk with China. And maybe there isn't political risk with China, but the perception of political risk can really hurt them.
I have one more question, and you have unique experiences. For listeners not aware, I've interviewed Tony in the past years ago. He used to work in China for many years. He worked with the Chinese government. He worked in the Belt and Road Initiative. So in your opinion, do you think China can easily de-dollarize from the US and the global financial system?
Oh, no, I think it would be very, very difficult. And I'm not really sure what the point would be because China exports so much right now. It wouldn't necessarily be in their interest to also invoice in the same currency at scale. It really helps them to have the US dollar as an external barometer. So I don't necessarily think they want to do that, although it's voiced. And I think there is a discussion to have an alternative to the dollar because, if you're Chinese, there is a lot of risk in one place with the US dollar, right? And if the US Treasury decides to embargo dollars from China, then China has a problem. So they do need an alternative global currency, but I don't think there is any interest in completely backing away from the US dollar.
I think there's a lot of false narratives out there by YouTube videos and clickbait artists and other people versus the actual reality and data numbers. So, I mean, US dollars for cross-border trade settlement are still around 60% of global trade and enormous amounts of reserves. But the narrative going around for the Belt and Road Initiative was that they wouldn't take dollars anymore. It was going to all be Chinese yuan. And was that the case when you worked in the Belt and Road Initiative?
No, all of the investments are nominated and lent in USD. So it just, for Belt and Road, it was just never, unless it's a domestic project, but for the international projects, everything was done in USD. And as far as I know, the vast majority of their projects are still nominated in USD. I could be wrong, but I haven't seen any news of any investments that they do outside of China that are nominated in other currencies. But again, I could be wrong.
And a lot of those dollars ended up back in China in the banking system and their companies, because it seems with the capital controls and their other policies, they don't want the US dollars that go into China. They don't want a lot of them leaving.
No, that's true. They need them. They have to pay their bills in US dollars as well. So they need these dollars. So, the problem with the Belt and Road is we talked about this before, but it was designed as a debt program where Chinese state banks loan to other sovereigns for the price of a piece of infrastructure. And that is generally 5% of the lifetime cost of that infrastructure. So when you build a bridge and it's $100 million, that's 5% of the lifetime cost of that infrastructure, because you have to maintain it, you have to upgrade it, you have to do all sorts of things, right? What's happened, and this happened probably 7-8 years ago with Indonesia, they were the first one to push China, the Chinese government bank, to say, hey, we don't want your debt, but we will take an equity investment from you, and you can be a 5149 investment partner with us. And the Chinese government initially resisted that pretty aggressively. But over time, they realized that they wouldn't get the zoning and all the other permissions they needed from the Indonesian government if they didn't hold an equity position. So the type of debt that they were initially planning was a very clean relationship, and they would be able to take those dollars back to China. With an equity investment, it's very different. That's a long-term commitment to that asset to build, maintain, and operate. And so the Chinese government now has currency and resources tied up in infrastructure all around the world that they didn't plan on having initially. Of course, in places like Africa, they didn't negotiate it as an equity investment. I'm not aware of any equity investments in Africa. It was all done as debt. So you have these African countries defaulting, or some of these African countries defaulting on the payback of this, and it's that's a risk calculation from the Chinese government more than anything.
So demand for Chinese debt is low, but it seems that in order to de-dollarize, it seems it would be very complicated because really, Tony, I've been hearing at least, and I've been covering this since 2010 with a lot of YouTube videos. Just every year or two, there's a new type of thesis coming out of how China and the BRICS, Russia are going to rapidly de-dollarize, whether it's a petro yuan, gold-backed petro yuan, a crypto yuan, something like that, some type of mix that BRICS working together in a currency that they're going to rapidly de-dollarize. And over the last 15 years, we've just actually seen very little evidence of it.
You're right. Eventually, they will be right, but will it be a year or from now, or 50 or 100 years from now? I don't know the answer. And I don't know that it makes a lot of sense. You're not going to have a BRICS currency, right? This talk about a BRICS currency for the last few years is just silly. It's not going to happen. Who's going to manage it? So you're not going to have a BRICS currency. And, I just think it's unnecessarily complicating things. If China does want to open their accounts and internationalize their currency, that creates a whole slew of problems for them at home. So I don't know why they don't just sit back and accept, the international monetary system for what it is. If they want to have more kind of Euro-active monetary policy, fine, go ahead and do that. But it just doesn't make sense for them to try to invent new vehicles because the confidence in those vehicles would be very, very low.
Well, the other problem is there's a ton of dollar-denominated debt inside the Chinese economy and their banking system, their shadow banking system, real estate developers. So they have pervasive amounts of, arguably the most amount of dollar-denominated debt inside their own economy. And then if you look at the numbers, and this is directly from the Bank of International Settlements, which tracks this and reports twice a year, every time the dollar gets weak, the amount of dollar-denominated debt from foreign governments and foreign corporations, it increases a lot. I think it increased when the dollar was weak. Last year? The dollar index was weak, and Peter Schiff and David Hunter were talking about dollar index at 85 or lower. You had record amounts of dollar-denominated debt, but that just creates more. It's a cycle. It's like a tug-of-war cycle. It stays in a trading range.
Right, and we've seen the dollar devalue a little bit or depreciate a little bit over the past few days too. So if that continues, you'll see emerging markets or middle income markets that need to take out loans, and they'll do it's easier when the dollar is depreciated a bit.
Yeah, I think the global financial system, it's not meant to run with Fed raising interest rates, strong dollar. That could potentially collapse the system, because then you start to see the dollar denominated debt in these emerging markets, the foreign governments, the foreign central banks just become too onerous, and then they have currency problems historically.
Yeah, then you get a Sri Lanka. So that becomes very difficult for everyone. Nobody wants a Sri Lanka, right? The lenders don't want a Sri Lanka. They don't want a company to fail, or a country to fail. Sri Lankans don't want a Sri Lanka, right? So it's the worst situation for everybody. So, it is a delicate situation for the Fed, but they mostly represent the American economy, but they also have to be aware of kind of the Eurodollar and the other dollar instruments and dollar denominated debt that their decisions impact.
Well, I would argue that they've been managing the decline of the dollar, but if you look at the dollar index, you wouldn't know that. So in
Exactly.
official government inflation rate purchasing power terms, I mean, the dollar has been substantially devalued for decades. It's just relative to the other fiat currencies, you wouldn't notice this.
Right. That's exactly right. So we can be as hard on the dollar as we want, but most other currencies are uglier.
Unfortunately, in this debt-based fiat currency world, we're now global debt's 300 trillion.
Yeah, we'll never pay it back. We'll never
Well,
pay it back.
I really enjoyed our discussion today, Tony. A lot of crazy stuff going on, a lot of cross currents and distortions. It's
That's
unfortunately
right.
policies from governments and central banks, because who would have thought that we'd see the Fed raise interest rates and then a stock market rally? But there's just a lot of red flags still with the banking system going forward.
It is. Yeah, it is. There are a lot of red flags, but things continue to stay green. So there's a lot to watch for, Jason.
If my listeners want to check out your work, want to check out Complete Intelligence, what products do you have and how did they do so?
So it's at completeintel.com. We have a subscription for market forecasts for currencies, commodities, equity indices, individual stocks. We do that for about $20 a month. We have higher price tiers, but that's probably the product your listeners would be most interested in. We also do enterprise and corporate forecasting for supply chains and corporate financial planning and analysis. All of that stuff can be found on the website, and I'm happy to help anybody.
Excellent. Well, thank you so much for your time, and we'll have to have you back on. And your analytics, your forecasting software is the accuracy rate is extremely high compared to a lot of competitors.
Thank you, Jason. Yeah, we're very transparent about that. We show all of our error rates, so I really appreciate that. Thank you so much.
And I come from the paid newsletter industry. I worked there for a long time, friends with a lot of them. And the paid newsletter industry is anything but accurate or transparent. So if they get something audited, I mean, it's normally heavily spun, or they're friends with the auditor, or they went auditor shopping.
Yep.
The newsletter industry does not have a good track record of success.
That's right. Exactly. So thank you for that. I appreciate it. And I appreciate your time today, Jason. This is really nice.